Well, hi everyone. Welcome to the Buffett and Beyond Research Saturday ETF report. This is June 6, 2026. And remember, folks, if you want to walk or live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And folks, QQQs over the past 6 months, well, this is Friday. I'm recording this in the middle of the day, and we are sitting on that 20-day moving average right in here. And yeah, it's down a nasty 17 points, the QQQs, as I'm recording this, which is quite a drop. And we talked about this on Thursday, where the market reached a higher high, and this indicator was reaching a lower low and starting to turn down. In other words, the black line turning down over that red line. That's a sell signal, which is a divergence. So the divergence is higher high on the market, lower high on that indicator. So it doesn't look too good going forward here, and we'll see if this 20-day moving average up here can hold on Monday and Tuesday. So it's going to be a weekend where you don't want to think about the market, folks. QQQs are up 17.7% for the year. Last week they were up 20%. So you can see we've dropped about 3 percentage points in here, with that QQQ sitting right on year to date, sitting on that 20-day moving average. And folks, that's the reversion to the mean, and we'll see what happens. But again, we've got this divergence, which we just talked about, higher high on the market, lower high on this indicator. And let us look at the S&P 500. Same story, except with this short-term indicator. You can see that yesterday, or I should say on Thursday, we had a rally, but boy, it didn't take us very far. When you're looking up here, you can say, hey, that rally almost touched the high of the year, but this indicator didn't even come close to getting back up there. And so that was, okay, you better watch out, because the QQQs already gave us a sell signal, and now the S&P 500 is sitting on its 20-day moving average, reversion to the mean, and we have that same sell signal in here. A higher high on the market, a lower high on this indicator. And let us look at the ETFs for the past week. Now, these are Thursday afternoon closing prices, so it doesn't reflect what's going on as I'm recording this, which is Friday afternoon. And we can see that oil and gas was right back up there at the top, where last week it was down near the bottom. Boy, that moves around a lot, at least on a weekly basis. Technology right here, and then energy, and then these semiconductors right there. So that's what we're interested in. Even the home builders came back a little bit this week. Why? Because Warren Buffett bought an entire home building company. And when you look back, and we mentioned it in our weekly letters about that last year, he bought into some companies, not the entire company. And here we are this week, and we find out that he bought an entire company. Now, what's the benefit of buying an entire company rather than just buying shares in a company? When you buy shares in a company, let's say Amazon, Apple, we all have those stocks. We have nothing to say about what they spend money on. But when you buy a whole company like Buffett likes to do, well, he's got the money to do it. When he buys an entire company, he can say exactly what he wants to do with all that money that's coming in, that the company is making. So Buffett could buy a housing company of one particular home builders and then put that money into other home builders or any other place where he deems he's getting a good deal. So that's the difference between buying shares of a company and buying an entire company, even though you hear a lot out there that when you're buying a share of a company, you're buying the company. Think about buying the whole company. Well, you're not, because you don't have any say when you buy a share of stock. Yeah, they let you vote on something every now and then, but not what they're doing during the week or during the year at all. And when you buy an entire company, you get to say what happens with that money, where you invest it. And so he can compound money that he's making from any company and compound it very, very well. And year to date, yeah, the XSD, which is the semiconductor, or one of the semiconductor ETFs, finally broke that 100% mark. But it's not doing that today. Remember, this is Thursday's close. So there you go. Semiconductors up 100%, technology up 34%, NASDAQ 100 up 20%. And here's the S&P, which is down a little bit over a point from this number, so it's down about 9%, or I should say up about 9% for the year, which is not bad, folks. And then down here, financials, home construction down here, and home builders right here. Just can't get away from getting out of the doldrums, even with the purchase that Buffett made, which gave the housing industry a whole boost, all the stocks a boost this week. And let us look at our top stocks versus the top computer stocks. So in other words, this is the computer that you have access to if you're subscribing to the ETF portfolios. And here we are with the XSD as of Thursday's close, up 100%. Our top stocks are up 60%. And if you just went to the computer and bought the top stocks, and there's quite a few of them, over the 20% threshold that we like to see, you'd be up 74%. So here we are lagging with only a 60% return for the first 5 months of this year, which isn't too bad, folks. Then when we come down to technology, our top picks are outperforming both the ETF itself and also the top stocks from the computer. So in other words, we look at just a little bit more than you do on the computer, even though all the information is there. But we look at it, and that we're going to bring that out in some seminars that we're going to do on Zoom, and we'll show you exactly what we do and what we look at to give us that edge that we have almost all the time. And then with the NASDAQ 100, there's just too many stocks in there. And what we did is we eliminated some of the stocks because they are in the XLK and the XSD. So they're in the technology, they're in the semiconductor. We didn't want to repeat them here, and that's why you see us underperforming. If you went to the top stocks and picked the ones that are over a 20% clean surplus ROE, you'd be up 20%, the same as the ETF. So really the thing to do is, or what we thought, and we're going back about 7, 8 years, is that if we go to the semiconductors and we go to the technology area, that we're overlapping a lot of stocks in the NASDAQ 100, and therefore we won't put them in the NASDAQ 100. So it shows that it's better to go to the smaller ETFs themselves and pick out the best stocks there. And a lot of you add these to your growth portfolio, and you keep writing me and telling me that you're doing very, very well with that. And then when we come down to the S&P 500, our growth portfolio, which is not just the S&P 500 stocks, but a few more stocks in there, but we use the S&P as a benchmark, and this is down to about 9.5% as I'm recording this, because this number you see was Thursday's close, and we're still up over 20% on our top stocks. So we're doubling the S&P 500 for the first 5 months of this year. And when we compare ourselves to the ARK Innovation ETF, which has its ups and downs for sure, folks. They're up about 4% for the year, and we have some of the same, a lot of the same stocks that is in ARK Innovation ETF, but we pick the larger stocks and the ones that have a history. In the Innovation ETF, there are smaller companies in there, and sometimes they do well in a good market, and sometimes they go to zero in a bad market. So we pick the larger ones, and that's really what's in our technology portfolio. So we're up 51% there. Home builders. Yeah, you have the home builders here, and then you have home construction here, and a lot of these stocks overlap. So a lot of the home builders are in home construction, a lot of the home construction stocks are in the home builders, and so what we did was combine these two portfolios and pick the best out of those portfolios, and we're up 6.3%, where they together average a little below zero. So the 2.02 and the negative 2.85%, and we're up 6.3%. So like Buffett, we think one of these days interest rates will come down, or people will get tired of waiting, and there is pent-up demand out there already, and it's just a matter of time before these stocks start taking off again, or at least that's our opinion on it. And so far, we're picking the best stocks, and we're still doing positive with these stocks. And our dividend growth and income portfolio with the dividend is up 8.5%, a nice, pretty conservative portfolio in here, where we look at stocks that are still growing but are also paying dividends. And it looks like at the beginning of this year we were paying the highest dividend out of the dividend and growth ETFs and funds that are out there. So we're happy with this 8.5%. Don't forget, we're only 5 months into the year, and we're getting about a 3.7% for the year return. And we take that dividend number from the beginning of the year when we get into these portfolios. And some of you have had some of these stocks for a very long time, so you're getting very nice dividends from some of these stocks overall from the time that you bought them. And we bring this up every week, and we're going to update it at the end of June. So we have a full 6 months in here. As you can see, this is as of the end of 2025, 5 months ago. And you can see that our top stocks that we pick out of an ETF outperform the ETF. And here we're looking at technology, doing twice as well as technology. And in the semiconductors, we're doing maybe 3 times more than the semiconductor ETF over 5 years ending 12/31/2025. So we'll bring this up to date, and you'll see that we're doing even better because we're really outperforming the Tech ETF this year. Not outperforming the XSD, but we're still up 60%. So that's pretty good, folks. We're still doing 60%. So yeah, it's been a good run over the past 7 or 8 years for our portfolios. And for our growth portfolio, over 23 years now, we're outperforming the S&P 500 on a compounded basis, 3-1, as we return about 17% a year in our growth portfolio, where the S&P returns about 10% per year on average. So 17% versus 10% per year. Compounded means a lot at the end of 23 years. So folks, here we are. We had a tumultuous week this week, and there I go using that word because that's exactly what it was between this week where we had our ups and our downs, but primarily a down week. And we've got those sell signals on our intermediate term indices. And so we'll see if the markets can hold those 20-day moving averages come Monday and Tuesday. So folks, you go out, you take care, you stay healthy, stay with your loved ones, go for a walk, forget about the market. We'll see you back here in a few days.